Welcome. Today, we're diving into the world of co-investment opportunities in private funds. If you've ever wondered how investors can access exclusive deals alongside major private equity players, you're in the right place. Co-investment is a growing trend, offering unique advantages for both investors and fund managers. In this video, we'll break down what co-investment means, why it's gaining popularity, and how you can potentially benefit from these opportunities. Let's start by understanding the basics before exploring the mechanics, benefits, and risks involved. Ready to unlock the secrets of co-investment? Let's get started. Co-investment refers to the practice where investors participate directly in specific deals alongside a private fund, rather than only investing through the main fund itself. This allows investors to put additional capital into select opportunities, often with lower fees and more control over their investments. Co-investments are typically offered by private equity, venture capital, or real asset funds to their limited partners. The goal is to create a win-win situation. Investors get access to attractive deals while fund managers can raise more capital for larger transactions. Let's see how this works in practice. When a private fund identifies a promising investment opportunity, it may invite its limited partners to co-invest directly in that deal. This means, in addition to their commitment to the main fund, investors can allocate extra capital to specific transactions. The fund manager typically leads the due diligence and negotiation, while co-investors benefit from the manager's expertise and access. Co-investment deals are usually structured as separate vehicles or side agreements, giving investors more transparency and sometimes better terms. Next, let's look at why co-investment is becoming so popular. Co-investment has surged in popularity over the past decade. Institutional investors, such as pension funds and endowments, are increasingly seeking co-investment opportunities to enhance returns and diversify their portfolios. The appeal lies in the potential for higher returns, lower fees, and greater control over investment selection. Fund managers, on the other hand, benefit by being able to pursue larger deals and strengthen relationships with their investors. This growing demand has led to more structured co-investment programs and dedicated teams within private funds. Co-investment opportunities are most commonly found in private equity funds, but they're also offered by venture capital, real estate, and infrastructure funds. Each type of fund presents unique opportunities and risks. For example, private equity co-investments often involve established companies, while venture capital co-investments might focus on high-growth startups. Real estate and infrastructure co-investments can provide exposure to tangible assets and long-term income stream. Understanding the fund type is crucial when evaluating co-investment deals. Co-investment offers several key benefits for investors. First, it allows for greater portfolio diversification by participating in select deals. Second, co-investors often enjoy reduced management fees and carried interest compared to traditional fund investments. Third, investors gain more transparency into the underlying assets and decision-making process. Finally, co-investment can provide access to high-quality deals that might otherwise be unavailable. These advantages make co-investment an attractive option for sophisticated investors seeking to enhance returns. Fund managers also benefit from offering co-investment opportunities. By inviting limited partners to co-invest, managers can raise additional capital for larger or more complex transactions. This flexibility allows them to pursue deals that might exceed the main fund's capacity. Co-investment also helps strengthen relationships with key investors, fostering loyalty and long-term partnerships. Additionally, successful co-investment deals can enhance the fund manager's reputation and track record, attracting more investors in the future. Co-investment deals are usually structured as separate legal entities or side vehicles, distinct from the main fund. Investors commit capital specifically to these vehicles, which are managed alongside the main fund's investment. The terms such as fees and governance are often negotiated separately. This structure provides clarity on ownership, rights, and obligations for all parties involved. Understanding the structure is essential for evaluating the risks and rewards of each co-investment opportunity. One of the main attractions of co-investment is the potential for lower fees. Unlike traditional fund investments, co-investment deals often come with reduced or even zero management fees and carried interest. This is because fund managers typically view co-investment as a way to build goodwill with investors and secure additional capital. However, fee structures can vary widely, so it's important for investors to review the terms carefully before committing capital. Due diligence is a critical step in any co-investment opportunity. Investors should thoroughly evaluate the target company or asset, the fund manager's track record, and the terms of the deal. This process often involves reviewing financial statements, business plans, and legal documents. Many fund managers provide detailed due diligence materials to co-investors, but it's essential for investors to conduct their own independent analysis as well. Proper due diligence helps mitigate risks and ensures informed decision-making. While co-investment offers many benefits, it also comes with risks. Investors may face higher concentration risk, as co-investments are typically larger allocations to single deals. There's also the risk of limited diversification, illiquidity, and potential conflicts of interest with the fund manager. Additionally, co-investors may have less influence over the management of the underlying asset compared to the main fund. Understanding these risks is crucial before participating in any co-investment opportunity. Co-investment opportunities are typically reserved for sophisticated investors, such as institutional investors, family offices, and high-net-worth individuals. These investors have the resources and expertise to evaluate complex deals and commit significant capital. Some funds may also offer co-investment opportunities to select limited partners based on their relationship or strategic value. It's important to understand the eligibility requirements before seeking co-investment deals. Co-investment deals often require larger minimum commitments compared to traditional fund investments. This is because the deals are typically larger and more concentrated. Minimums can range from several hundred thousand to millions of dollars, depending on the size and nature of the transaction. Investors should assess their own risk tolerance and liquidity needs before committing to a co-investment opportunity. Most co-investment opportunities are sourced through relationships with fund managers or through formal co-investment programs. Some investors may also access deals via investment consultants or placement agents. Building strong relationships with fund managers is often key to gaining access to the most attractive co-investment deals. Networking and reputation play a significant role in this process. Fund managers play a central role in sourcing, evaluating, and managing co-investment opportunities. They leverage their expertise, networks, and resources to identify attractive deals and negotiate favorable terms. Managers also handle due diligence, ongoing monitoring, and reporting for co-investors. Their alignment of interests with co-investors is crucial for the success of the investment. Key feature of co-investment is the alignment of interests between fund managers and investors. Since both parties have capital at risk in the same deal, their incentives are closely aligned. This can lead to better decision-making and stronger performance. However, it's important for investors to ensure that the terms of the co-investment do not create conflicts of interest or disadvantage them relative to the main fund. Governance structures in co-investment deals can vary. Some co-investors may have limited rights while others negotiate for more control or oversight. It's important to review the governance terms, including voting rights, reporting requirements, and exit provisions. Clear governance helps protect investor interests and ensures transparency throughout the investment lifecycle. Co-investors typically receive more detailed reporting and transparency compared to traditional fund investors. This includes regular updates on the performance of the underlying asset, financial statements, and key developments. Enhanced transparency allows investors to monitor their investments more closely and make informed decisions about future commitments. Exit strategies for co-investment deals are an important consideration. These can include sales to strategic buyers, initial public offerings, or recapitalizations. The timing and process of exits may differ from the main fund, so it's important for co-investors to understand their options and any restrictions. Proper planning helps maximize returns and manage liquidity. Legal documentation for co-investment deals can be complex. Investors should carefully review all agreements, including subscription documents, side letters, and governance provisions. Engaging experienced legal counsel is recommended to ensure that investor rights are protected and that all regulatory requirements are met. Legal due diligence is a critical step in the co-investment process. Tax considerations can significantly impact the returns from co-investment deals. The structure of the investment, the location of the asset, and the investor's own tax situation all play a role. It's important to consult with tax advisors to understand the potential implications and optimize the investment structure. Proper tax planning can help maximize after-tax returns and avoid unexpected liabilities. Regulatory environment for co-investment varies by jurisdiction and asset class. Investors must ensure compliance with securities laws, anti-money laundering regulations, and other relevant rules. Fund managers typically provide guidance on regulatory matters, but investors should also conduct their own due diligence. Staying informed about regulatory changes is essential for successful co-investment. Let's look at a real-world example. Imagine a private equity fund identifies a promising company but needs additional capital to complete the acquisition. The fund invites its limited partners to co-invest directly in the deal. Investors benefit from the fund manager's expertise in due diligence while enjoying lower fees and direct exposure to the company. This structure allows for greater alignment of interests and the potential for enhanced return. The venture capital space, co-investment often involves high-growth startups. For example, a VC fund may lead a funding round and invite select investors to co-invest alongside the fund. These investors gain access to innovative companies and the potential for outsized returns, but also face higher risk and volatility. The fund manager's expertise in sourcing and managing startups is a key advantage in these deals. Real estate co-investment allows investors to participate directly in property acquisitions or developments. For instance, a real estate fund may offer co-investment in a commercial building project. Investors benefit from tangible assets, potential income streams, and the expertise of the fund manager. However, they must also consider risks such as market fluctuations and illiquidity. Infrastructure co-investment involves large-scale projects like energy, transportation, or utilities. These deals often require significant capital and long investment horizons. Co-investors gain exposure to essential assets with the potential for stable, long-term returns. However, they must also navigate regulatory, operational, and political risks unique to the infrastructure sector. In evaluating co-investment opportunities, investors should consider several factors: the quality of the underlying asset, the experience of the fund manager, the terms of the deal, and their own risk tolerance. It's important to conduct thorough due diligence and seek advice from experts. A disciplined approach helps identify the most attractive opportunities and avoid potential pitfalls. Building a diversified co-investment portfolio requires careful planning. Investors should aim to spread their capital across different sectors, geographies, and deal types. This helps manage risk and enhance the potential for consistent returns. Regularly reviewing and rebalancing the portfolio is also important to adapt to changing market conditions and investment goals. Advisors play a valuable role in the co-investment process. They can help source deals, conduct due diligence, negotiate terms, and provide ongoing monitoring. Working with experienced advisors can enhance the quality of investment decisions and reduce the risk of costly mistakes. It's important to choose advisors with relevant expertise and a strong track record. Technology is transforming the co-investment landscape. Digital platforms and data analytics are making it easier to source, evaluate, and manage deals. These tools provide greater transparency, streamline due diligence, and facilitate communication between investors and fund managers. Embracing technology can help investors stay competitive and make more informed decisions. Several trends are shaping the future of co-investment. These include increased demand from institutional investors, the rise of dedicated co-investment funds, and greater use of technology. Investors are also seeking more customized solutions and flexible structures. Staying informed about these trends can help investors identify new opportunities and adapt their strategies. Despite its advantages, co-investment comes with challenges. These include limited access to deals, the need for rapid decision-making, and the complexity of legal and tax issues. Investors must also be prepared to dedicate significant time and resources to due diligence and ongoing management. Understanding these challenges is key to successful co-investment. Succeeding co-investment, investors should follow best practices, conduct thorough due diligence, negotiate favorable terms, diversify across deals, and work with experienced advisors. It's also important to maintain strong relationships with fund managers and stay informed about market trends. These practices help maximize returns and manage risks effectively. Fund managers can enhance their co-investment programs by maintaining transparency, aligning interests with investors, and providing timely communication. Building trust and delivering consistent performance are essential for attracting and retaining co-investors. Managers should also invest in technology and talent to support their co-investment activities. Co-investment is a global phenomenon with opportunities spanning North America, Europe, Asia, and beyond. Each region offers unique opportunities and challenges, influenced by local market conditions, regulations, and investor preferences. Understanding the global landscape can help investors identify attractive deals and diversify their portfolios internationally. Market cycles can have a significant impact on co-investment opportunities. During periods of economic growth, more deals may be available, while downturns can create attractive valuations for disciplined investors. Understanding market cycles and timing investments accordingly is an important aspect of successful co-investment. Environmental, social, and governance (ESG) factors are increasingly important in co-investment decisions. Investors are seeking opportunities that align with their values and contribute to positive social and environmental outcomes. Fund managers are responding by integrating ESG criteria into their investment processes and reporting. ESG considerations can enhance long-term value and reduce risk. Future of co-investment looks promising. As more investors seek direct exposure to private markets, co-investment is expected to grow in scale and sophistication. Advances in technology, evolving investor preferences, and regulatory changes will continue to shape the landscape. Staying adaptable and informed will be key to capitalizing on future opportunities. There are several misconceptions about co-investment. Some believe it's only for large institutions, but family offices and high-net-worth individuals can also participate. Others think co-investment is risk-free, but it carries unique risks and requires careful evaluation. Dispelling these myths helps investors make more informed decisions. Before committing to a co-investment, investors should ask key questions. What is the fund manager's track record? What are the terms and fees? How does the deal fit with my overall portfolio? What are the risks and exit options? Asking the right questions helps ensure that the investment aligns with your goals and risk tolerance. Investors should be alert to potential red flags in co-investment deals. These include lack of transparency, misaligned incentives, overly complex structures, and unrealistic return projections. Conducting thorough due diligence and seeking independent advice can help identify and avoid problematic deals. Negotiating favorable terms is an important part of the co-investment process. Investors should focus on fees, governance, reporting, and exit provisions. Clear and fair terms help align interests and protect investor rights. Don't hesitate to seek expert advice during negotiations to ensure the best possible outcome. Ongoing monitoring and management are essential for successful co-investment. Investors should regularly review performance, stay informed about developments, and communicate with fund managers. Proactive management helps identify issues early and make timely decisions to protect and enhance value. Experience is a valuable teacher in co-investment. Learning from past deals, both successes and failures, helps investors refine their strategies and improve outcomes. Sharing insights with peers and advisors can also provide valuable perspectives. Continuous learning is key to long-term success in co-investment. Wrap up: co-investment opportunities in private funds offer unique benefits and challenges. By understanding the mechanics, conducting thorough due diligence, and following best practices, investors can unlock attractive opportunities and enhance their portfolios. Remember, success in co-investment requires discipline, strong relationships, and a commitment to continuous learning. Thanks for joining us on this journey into the world of co-investment. Stay curious and informed as you explore new investment horizons.